Hello, everybody. Welcome to the Cafe of Knowledge. So glad that y'all are tuning in today. Please hit the like and subscribe button. Last week, y'all know that we was talking about the financial reports and balance sheet. We did balance sheet. So that was last week was the balance sheet. Okay, so now that you know, this is chapter 17, y'all. So now that everybody know about the double entry accounting for your business or wherever you are working at, and if you own your own business, you know all these things now, okay? So we are almost coming up towards the end of this whole chapter process and the whole thing of learning about inventory accounting, finance, budgeting, and all that good stuff. So we're on chapter 17, and chapter 17 is the auditor and the auditor's report. Okay, so we'll be talking about that today. But you all know how to do your double entry accounting. Y'all know how to do the income statement. You know how to do the balance sheet. You know how to do the financial report. All of these things that you keep up with, all of these sheets. Now that you have all these sheets together, you know how to do all these sheets. You know how to keep all these sheets for your company. If you don't, please refer back to the other videos, and they have the title, income statement, financial report. It has all those things, and you'll know how to get those things in order for your business, because those are very, very important for your business. You need them to see what's going on inside your business, to see how well your business is doing, and also for the end of the year, your tax purposes, okay? To make sure that your company or the company that you're working for are reporting the right amount that they have made all year long, and what they are doing. And because it's very important for your income tax report for your business or for the business you are working in. Okay, so now, of course, once you have all those reports together, and that's your financial report, your income statement, your a double entry counting. When you have all of these reports together, reports and the balance sheet, you get all those reports together. Now it's time for you to find an auditor to come in at the end of the year. Now you keeping up with all these paperworks, that all these reports we talked about, you keeping up with them like every 4 months, every quarter, which is every 4 months. You're keeping up with all these reports. You're putting down all these reports, all that good stuff. At the end of the year, you have an auditor come in. So if you own a business, you would want to have an auditor to look over your work, to make sure that everything is okay. And if you are working for another company, once you have all this paperwork and all your reports together at the end of the year, then you would say, okay, now it's time for me to call an auditor to come in, okay? The person that's keeping up with the reports, if you're a business owner and you are the one keeping up with their reports, you can't do the audit yourself. You do have to call somebody in, because that way it shows that that person has no interest in trying to make your company look good or make your company look bad. They're only there to make sure all the reports are correct, all the numbers are correct, what you say you made is really what you made, and that everything is okay. Okay, that all the reports are telling the truth. That way, when you do file it for income tax purposes for your business, then they know that these paperwork has been checked and checked by an auditor, so there's no discrepancies really. Okay, now if you are in a business and this is your job to do, to keep up with all these reports, then it's your duty, or you go to your owner of the business and tell them all the paperwork for the year is ready. Might want to bring in an auditor when you get ready to, and you will have it sitting there waiting on an auditor to come in and look over that paperwork and make sure that everything is okay within that business, okay? But that's the purpose of having an auditor to come in and check and make sure everything is okay before you take your paperwork to the tax office, because everything, all your reports are going to have to go to your tax revenue place, and then that lets you know where your company stands. You know, they file your taxes and do all that for your business, okay? And so you don't want your paperwork to be wrong. Then you don't get an auditor or somebody to check it out or whatever. You don't want your paperwork to be wrong, and then you wind up having to pay, the IRS money, or a whole lot of money, because your paperwork ain't right. Or the IRS find out later on, looking through your paperwork, that something don't look right, and then they start fining you and charging you, and you having a whole bunch of IRS problems and all that stuff right there. That's something that you don't want. Okay, so now an auditor comes in, and they review all your reports. Once again, they review your double entry accounting report. They review your income statement report. They review your balance sheet. They review your financial report. Okay. Now, what an auditor does is an auditor report. When an auditor come in, they'll look at all your paperwork, all your reports, and then they come in, and this report will show if the auditor raised any red flags about the company financial statement. Okay, so if they feel like there's some red flags in there, they'll let you know. They don't change it. An auditor don't change it. All the auditor do is go into each report and make sure that each report is accurate to the best of the company's ability. Accurate. Okay, now, like I said, everybody who has been following this Cafe of Knowledge, and y'all been following all of the tutorial videos from chapter 1 all the way to chapter 17 today, you know how to be an auditor now, because you know exactly what to do for an income statement, how to fill that out. You know what it takes to be on there. You know how to make sure it's right. You know how to do a balance sheet to make sure it's right. You know how to do a financial report to make sure it's right. You know how to do double entry accounting to make sure it's right. So if you wanted to, you can now apply to be an auditor, to go inside of a business and just check all the financial reports, because you know now how to make sure that financial report, that income statement report, that double entry, you know what to look for and to make sure that things are right. You know how to do the inventory. You know how they got week 1, week 2, week 3, week 4. You know what's supposed to be on every month's sheet, and what the company brought in, and what the company profits was, and their profit losses. You know all of this stuff at this point if you have been following all of the tutorial lessons that I have been doing from chapter 1 all the way to chapter 17. If you have been following from 1 to 17, you are now ready to be an auditor. If you just want to apply for an auditor job, you know what you are doing. You could be an independent auditor, okay? You could just look it up and go through the steps to be an independent auditor, because you know what you're doing, you know what you're looking for, all that good stuff, okay? So anyway, that's what an auditor does. Go in, check all the paperwork, all those reports I named, to make sure that all those reports are right and correct, okay? The auditor will not give any information about whether a company is a good investment. Like, once they look over the report, all your stuff, and they say, okay, they don't go and tell other people, investors, that, oh, that company's not a good investment, or that company is a good investment. They don't do that. They just come in, check, put down anything that they see or they see wrong, or what might be okay, and they sign it and they leave it at that, and they put their little stamp on it, and that's it, okay? They don't change any numbers off a company's report or anything like that. They are just strictly there to look at it. And if it look like this report might be shaky and they got some false numbers, or the numbers ain't adding up or something like that, hey, they don't change the numbers. They just write it down on their auditor report that numbers don't look like it's adding up. I found 2 or 3 discrepancies. They'll say something like that. Okay, so let's get into what that auditor does. Okay, so the auditor report, when an auditor comes in, an auditor does a report on everything that company has presented to them. All their reports and everything. Only thing the auditor do is look at it, and it's 3 key things, okay? 3 key things that an auditor looks at when they go into a company, okay? Now, what the auditor do, number 1, is they have the auditor on their auditor report. On the first line, it'll have introductory paragraph, okay? That's your introduction, like, this is your introduction to what's going on in that company, okay? So that first line would be like your introduction paragraph on what's going on. And this will show, this paragraph here, this will show the time period the auditor reviewed and covered the company's financial report. So on this line, it's going to tell what period. Was it at the end of the year, or did they come in and audit, did you call for an auditor in the middle of the year? And that would be like, okay, if you came in, a company say, hey, could you come in and just audit our work, because something just don't look right, or my bank account ain't looking right. If somebody call you in like that in the middle of the year, you have to put what period that is. You ask the company, what period are y'all in? Are y'all in quarter 1, quarter 2, quarter 3, quarter 4? And then you will put that at the top in that paragraph, okay? But normally, businesses call an auditor in at the end of the year. No matter if you are if you're a small business, you probably could just take it. I mean, you can take it on at the end of the year. You could take all your reports and just take it straight to the tax people. But for them to they have to look over it and do all that stuff the same way that an auditor does. And it's good to have an auditor to do it and then take it to the tax people, because it shows that you brought somebody in to look over and to make sure everything was properly correct to the best of that company's ability, okay? So on that first line, that introductory line, paragraph, like I said, it shows the period the auditor reviewed and covered this company financial report. It also will show the managers and the executive, meaning the owners, who is responsible for the financial report. Okay, so on that introduction line, you tell when you did it, what period you did it, what day it was, all that good stuff. And then you will also put the managers or that secretary or whoever in charge of the financial reports or income report, all the reports, and the owner, all their names go inside of that paragraph, okay? And then you would have scope paragraph. It's called scope paragraph, like you scoping things out, okay? That be the next thing you put on an auditor report, or you will see on an auditor report, okay? This is the paragraph in which the auditor will make statements that the company's financial statements is free from misstatements and free from misleading information. Okay, so like I said, that's after that auditor review all the reports. If they feel like, okay, yeah, all these numbers match, when they look through every one of your reports and they'll say, oh yeah, okay, okay, the numbers look right. And the numbers are matching up from month to month to month to month to month. Because you remember, you got 12 months in a year. So this auditor is looking at each month and making sure that everything is coinciding what the company say it really has. Okay, and if the numbers don't add up or the numbers don't look right, and we all know how to check and make sure if the numbers are right, and we all know how to look and see if the numbers don't look like they matching. We already know how to do that because we did them in previous videos. Okay, so now that's what that auditor do on that scope paragraph. It goes through all those reports each month and make sure that they all are coinciding with each other and ain't nobody trying to put numbers or something like that. Now let me give you an example. Say if January, the company said at the end of the month it had $2,000 in the bank in January. That's at the end of the month. It says they made a profit of $2,000. But then in February, when they start the report again, you know, you got to carry the numbers over to the next month. But say in February, it says their profit was $500. Their profit is $500. You would say, wait a minute, your profit still supposed to be $1,000 because you carrying it over for the first week of February. So why did you say you had $1,000 in the bank profit, but then in February at the beginning you started off February with $500? What happened? Okay, you say you had $2,000 at the end of January profit, and then the beginning of February, you starting off with a profit of $500. Something ain't right. That means $1,500 is missing somewhere. Now, that auditor is not going to change them numbers. It's just going to jot down that discrepancy from January profit to February beginnings. Like that. They will put something like that. That's what an auditor do. An auditor is looking to see if anybody playing with numbers or see if the numbers are coincided the way it is. Because if that company had $2,000 in profit at the end of January, at the beginning of January, we starting a new month, haven't even started anything yet, it still should be a profit of $2,000 at the beginning, you know. So if it's changing and swapping, I'm just giving y'all kind of examples of that's what auditors do. They look for discrepancies in numbers, discrepancies in a lot of little different things, and they do jot it down inside of that scope paragraph. Okay? So, like we said, an auditor report has 3 main keys to it. It's that introduction paragraph. Told you what that's supposed to be. The scope paragraph. That's what we're talking about now, okay? And the scope paragraph, the auditor will also state that they planned and performed the audit by using acceptable audit standards. They will put that down. You know, like we said, after they go through all the reports, they don't see nothing wrong, they'll say they don't see anything wrong. They'll say they don't see any discrepancies, everything looks good, all that good stuff. And then they'll also say the audit was performed by whoever they are, or you, or your name, and things like that, if you just decide to be an auditor. Okay? You put your name and all that stuff, acceptable standards, that, you putting all your keywords down there to let them know that, okay, I checked it. I am accountable for checking it. Everything that I checked, I feel good about. No discrepancies found in this company. If you found discrepancies, you will put what discrepancies you found, and then your name, and you stand by it. That type of stuff like that. Okay. Now, most times in the auditor report, this is still up under the scope. They're looking for materials of misstatement. Okay, that's the real scope of. That's what you put in that scope paragraph. An auditor, I already said that. They looking for discrepancies. Okay, they looking to see if this company is telling the truth month to month to month to month about their numbers, about their sales, about how much money they bringing in, about how much profit they have, all that good stuff. Okay, and it's not good for the owners to do that, because owners have an interest of conflict. Owners, they'll change numbers to make some of them, not all, but you have some that, because they want their company to look good, they will play with the numbers and make the numbers higher to make their business look like it's doing real good. And really, it's bad to do. Everybody knows it's bad to do, because you're saying you have more than what you really have, and you can't run a business by lying about what your money-making business is doing. You can't be, you'll never get anywhere doing that, because you ain't even know where your company stand, because you're too busy playing and lying with the numbers. Okay? But that's what auditors do. Auditors can catch little stuff like that. Okay? So they looking for materials of misstatements. That's what they do. And this is when a company sometimes the company will make an honest mistake on some of their reports, and the auditor will catch it. They be like, how come this say 1,000, but I'm adding it up, it should be 500. And somebody might say, oh, my bad, I'm sorry, whatever. Well, they really can't change it right then. They can't change it, because the auditor will put down there, on such and such, I found they had 1,000, but, it's really supposed to be 500. You know what I'm saying? So that's what an auditor does, and you have to leave it like that. They can't, after the auditor leave, the company can't go back and change the auditor report. Because the auditor have a report themselves that they make a copy. When they get through doing the audit, when they get through auditing that store, they give them a copy, the store a copy, and they keep a copy. So therefore, if something ever comes up with the IRS or anything like that about, hey, this don't look right, but you signed off on it, and then that's when that person, that auditor, will get out their report and say, nah, I ain't do that, and then they'll send in the real thing, and then that company will be in trouble for messing with the auditor's report. Okay, so that's how that goes. So make sure y'all understand and know that. Now, they're looking for any misleading information inside of all those reports. This is what an auditor do. Is looking for all these things. They're just making sure that everything is correct in every piece of report that the company gives them. And the auditor know that, hey, they know to ask for, where's y'all income statement? Where's y'all financial statement? Where's y'all double entry accounting sheet set? They know to ask for all these things. Okay? And where's your financial report? Balance sheet. They know to ask for these things, because these things is what is needed for an auditor to make sure that it knows how this company is doing. Okay, and how to write off. So that's all that an auditor does when they come in. Okay, so like I said, rather you are a small business and you own the company and you just look around, and anybody who do auditing work, You can call them up and have them come into your store, look over your paperwork, make sure it's okay before you turn it over to the tax people. Okay? If you want to be an auditor, the one who comes in and audit a store, you can do that because you know how to do that. And like I said, if you've been following all my videos from chapter 1 to chapter 17, you know how to audit now because you know how to do everything in a business and how to keep up with paperwork and how the paperwork is supposed to be done and how the paperwork is supposed to be accurate. Okay? So now, the third thing that an auditor has on their report is an option paragraph. Okay? And the option paragraph is the auditor states their opinion of the company's financial statements. If the auditor don't find any problems with the financial statement, the auditor will simply state that the statements in the financial statements are prepared with generally acceptance accounting principles, okay, which is called in parentheses GAAP, okay. GAAP is abbreviation for generally accepted accounting principles, okay. So that's what that last line will have. The auditor will state their opinion of the company's financial statements, is what I just said earlier. It'll have down there, didn't find any discrepancies or anything like that. I reviewed all the reports, didn't find any discrepancies. Everything in their financial statements, their financial reports looks good, okay? And it looks good to the ability of generally accepted accounting principles, meaning that they are using correct accounting principles when they prepared all of their reports. Okay? So that's basically just what the auditor is saying, is that this company have a good practice of keeping up with their reports because all of their reports look accurate. All of their reports looks correct. No discrepancies in there. So they are following the right way and the good accepting principles of keeping up with their accounting paperwork. Okay? That's basically what that last option paragraph, what an auditor will put in there. Okay? They will put that in there. And in that option paragraph now, non-standards auditor report, meaning that this is, now remember this option paragraph is putting that, okay, everything looks, this is if the company looks good, all the numbers look good, everything is adding up, everything look correct and all that stuff. They'll say, okay, yeah, they are following the proper GAAP, which is that general acceptance accounting principles. They're following everything they need to do, for is accounting for this business. But if they finds that something is wrong in there and that company is not following the general acceptance practices of accounting, right, then they would put a note that says non-standards, mean they not holding up standards on their paperwork. Their paperwork, they got a lot of discrepancies in there, okay? That's when they will say non-standard auditor report. And they will put down what they found as discrepancies. And this is when the auditor find a problem in the company's financial statement. The auditor will explain their opinion and note problem areas that they found in that company's financial statement. Okay? So that's all that an auditor does when they come in, okay? An auditor has to make sure that everything is correct for is all that company's paperwork for that whole year. They just come in and they look and they make sure that everything that that company said they made that whole year, what they spent that whole year, all that stuff have to add up, because all that stuff is very important when you're filing that company's taxes. Okay, it's very, very important, because IRS will be also, when it's sent in to the IRS will also do the same thing an auditor is doing. Look through every piece of information to make sure that this business is telling the truth, and what they say they earn is what they earn. What they say they bought is what they bought. How much they say they spent is really how much they spent. Making sure that everything is correct, and then the IRS will then, you will know if you owe the IRS money from your business, or do your company receive money from the IRS. But everything has to be correct, and that's why you like to have an auditor come in and look at all of your reports, because you don't want the IRS to come back chasing after you. And if the IRS come back chasing after you and they say it's due to this and this and this and this, then you can kind of look at the auditor and be like, hey, look, you said everything was all right, but it's not. And then the IRS will get in contact also with the auditor who said everything was okay, but IRS seen everything wasn't okay. Okay, so you just have to look at that kind of things like that. Then they have a thing called, on that auditor report, material uncertainties. Okay, like if you are uncertain, material uncertain. Okay, if you are uncertain about something, this is when the auditor finds an area in the financial statement that raised serious questions concerning the company's potential financial position. The auditor may find financial misleadings, that a company might be facing, like pending lawsuits, anything that can damage the company. So on that next line on that auditor report, for that material uncertain, like it's really a lot of uncertain. I'm uncertain about this, okay? And when that auditor looks through all that paperwork and everything, y'all, if that auditor see that, because they have to turn everything in. Say if that company is being sued for that year, they have to put that inside of their reports, okay? And y'all know which reports that should go up under. And if you don't, refer back to all the income statement, balance sheet, and all that reports. Because in those reports, remember I told everybody that you have to put your liabilities on there, things that you're liable with, things that you're supposed to be paying out. And if it ain't yet paid out, or what's pending that you have to pay out. So that, if you got a loan, and the loan, you got to pay out a loan, and the loan going to take more than a year to pay off, everybody know where to put that at. If you don't, refer back to the other videos. But if you've been hit with a lawsuit, and maybe the lawsuit has not yet been to court or anything else, you still have to put that inside that business. So that auditor will see that, okay, the company is being sued for something. The auditor will note that, that, okay, that will go under material uncertain, meaning that the lawsuit might bankrupt the business, or the lawsuit might not bankrupt the business. You just never know. So they will put that down there, company facing lawsuit. They won't say what the lawsuit is about. They just see that, and an auditor, sometimes the auditor will ask, even though the company, they don't see it in any reports, they'll ask that. Are is your company facing any lawsuits right now, or has anybody filed a lawsuit against your company or anything? Oh, yeah, they did. Okay, well, where's that at? I need to see that. And once they see it, they're not going to put on that paper what that lawsuit is about. They will just see that, oh, yeah, y'all are. They just want to document that they are being sued for something. And then they will put that under material uncertainty. Okay? They will put company is facing a lawsuit. And they have to put that down there, because what if somebody wants to invest in that company later? All this stuff should be in their reports, and investors wants to know this. And so investors will ask a company too, where is y'all auditor report for the year? Because they know if that company is facing anything shaky, it's going to be on the auditor report. And if that company is facing any lawsuits, it's going to be on the auditor report. Okay, so all they ain't going to say what they're being sued for, but it's going to say that that company has a lawsuit against them, pending on them, or they lost the lawsuit, or they just had a lawsuit. Okay, and then that investor know if they want to invest or not in a company that's inside of a lawsuit already. That's when some investors say, nah, I'll wait till all that's over with and then see where y'all stand. So that's what that next line of material uncertainty, that's what goes down there. Okay, so if a company is have a lawsuit pending that may damage the company's financial position, which I already told y'all that. Agreements of violation, loss of major customers. You remember we talked about that, how to look at the paperwork on how many customers a company is losing every year. The auditor will put that on there. We talked about that in the previous videos, about looking at a chart and seeing that a company had 1,000 customers last year, but this year they only had 500 customers. Well, they done lost 500 customers this year. Why? What's going on inside this company? Well, that's all an auditor do, is look and see how many customers did they have all year, right? And then that auditor will look and see how many customers they had last year. And if it has dropped tremendously, that auditor will jot that down. They will write that down. If the customer has increased, say they had 1,000 customers last year, and this year they got 2,000. They had 2,000 customers come into their establishment and their business this year. Then that auditor will write that increase in business. They will say the company that's under these material uncertain. It will say customers are increasing in this business. This business is increasing in customers, which means that they should be increasing in sales. Okay, so they will write that down there. But they will also write if that company done lost a lot of customers from 1 year to 1 year, they will write that down, because that is showing that something is not going right inside of this company for them to lose so much of their customers in 1 year. And something is going wrong. So if they got a trend of losing 500 customers this year, next year they might have a trend of losing another 500 customers, and it won't be long before they be out of business. So that's how the auditor looks at it. And they would write that down, that they have lost customers, a substantial amount of customers. So they'll put that on the report as well. So that's what all goes on an auditor report. And then the auditor will basically sign everything. The auditor will make a note explaining situations about the company, and that's about it. And then the auditor will sign off and put their stamp on it and hand it over. And that will be the company's audit report for that year or for whatever period that auditor was there. But that auditor report means a lot for a lot of people. It means a lot for the investors. It means a lot for the company, the owner of the company. It means a lot to the tax people, the IRS. It means a lot to everybody. That auditor report really does mean a lot, and it tells a lot of people where that company stands. And an audit report should be done, whether it's a small business or a big business. Auditor report has to be done so that you will know where you stand. Okay, and like I said, everybody who has been following me from chapter 1 to chapter 17 already, y'all already know how to do an auditor report, because y'all know now. And that's what I was saying about this show. It teaches you how to do so many things. So you can apply or try to be an independent. You can look up now, because you know how to do auditor work. If you have been following, like I said, from chapter 1 to chapter 17, you are ready to be an auditor. And you could be an independent auditor. You running your own auditor business, and you could just go in and you'll make you some old business cards and everything, and get yourself together and get all the paperwork you need for you want to do your own independent auditing work, and go get your business license and all that good stuff like that, and then start telling people that you know how to be an auditor, and you are willing to do their auditing work and things like that. So just promote yourself. So like I said, you could be an auditor, or if you're inside of a business, you know when an auditor comes in, what an auditor is looking for and what has to be correct for that auditor to write you a good report with no discrepancies, okay? So either way, you know how to do it, and that's the main goal, is to make sure that everybody knows to increase their ability in their career, so they can go out here and better themselves and better their career all the time. That's all I have for today. Next week we will do the annual report, and the annual report is that last main report that needs to be done. Okay, anyway, gain knowledge to prevent blockage, and we all know what that means. The more you know, the harder it is for anybody to block y'all from your goals and success. Bye bye. See y'all next week.